In the first 9 months of this year, $36 trillion in value has evaporated from global financial markets. Just this past week, the Bank of England had to bail out the country's pension system to prevent a catastrophic collapse. And now there's rumors circulating on Twitter that Credit Suisse is about to fail and that SoftBank and Deutsche Bank are right behind them. But this is not just another run-of-the-mill global financial crisis. At risk of sounding cliche, this time is different, and it is way different. What's up, guys? I'm nobody special, and if you think turning on the money printers will come to the rescue and save us from this crisis, you got another thing coming, because there has never been a crisis like we're facing right now in global financial markets. I was talking to my good buddy Chris Taylor over at Financial Prepper yesterday, and I mentioned to him that everyone is looking at this crisis through the lens of the last crisis, and the crisis before that, and the one before that. And that's a problem because we can't do what we've always done this time around. Now, if you've been following my channel, you've seen this chart an awful lot over the last year. This is the U.S. 10-year Treasury yield. This is the interest rate by which all other interest rates are measured. And you can see every time since the 1980s that we have had some kind of financial crisis, the answer has been to lower interest rates, and more recently to lower interest rates and print money, otherwise known as quantitative easing. Black Monday in 1987, the bond market massacre in 1994, the dot-com bubble bursting, the global financial crisis, and then more recently the Powell pivot, and eventually the unfortunate health situation of 2020. Every time things got hard, the answer from central banks was to lower interest rates and or print money. In other words, easy money was the solution, and that worked, or at least that kicked the can down the road. It didn't solve the problems, but it stopped the immediate bleeding. The problem is, after 40 years of doing that, now we have this massive inflation problem. So the problem is, if the central banks just keep turning on the money printers, they're going to make this inflation problem worse. Now, everybody laughed at guys like me in 2020 when the stimmies were rolling out, and everybody was happy to get that $600 check in their mailbox or that $1,200 deposit in their account. Everybody just wanted their stimmies. Nobody wanted to hear about the inflation problem. Well, here it is. The inflation problem is here, and stimmies will not solve that problem. Stimmies will make it worse when you give people more money to spend. Funny thing, they go out and spend it. Well, more money chasing the same number of goods and services means the price goes higher. That's inflation. So if Credit Suisse is about to fail, if UBS or HSBC or SoftBank or Deutsche Bank or any of the other banks are about to blow up, it's not as simple as turning those money printers back on, because that's going to make the inflation problem worse. And not to mention the fact that these banks are much bigger now than they used to be. If you consider the size of Credit Suisse or Deutsche Bank and some of these other banks, they are way bigger now than Lehman Brothers was in 2008. So if these banks are about to go belly up, the bailouts would have to be even bigger. That's even more helicopter money. That's even more inflation. So they can't just turn the printers back on. Now, that's one whole set of problems that they can't solve without making something else much worse. Right now, they're raising interest rates to try to get inflation under control, and it's starting to cause liquidity problems. It's starting to cause problems with the pensions in the UK, and it's starting to cause bank stress, and it's causing this $36 trillion of wealth in global markets to go up in smoke. Now, since my channel first started, I've been talking about how the government manipulates the statistics to make inflation seem like it's not really as bad as it is. If you actually go by JohnWilliamsShadowStats.com, where they calculate inflation the same way they used to calculate it in the 1970s, then inflation right now is actually higher than it was in the 1970s. And the reason I point that out, because look at this chart again at how we got out of the inflation problem back in the 1970s. That was Paul Volcker taking over at the Federal Reserve in August of 1979. And Paul Volcker went postal on interest rates, raising them above 15% in order to get that inflation down. Now, here we are after the first 6 months of the Fed raising interest rates here in the States, and we're just at 3% right now. So we would have to continue down this current path, which is already causing problems, for years in order to get to where Paul Volcker got to stop the inflation last time. And remember, the inflation this time is even worse than it was last time. The problem is we can't do that either, because take a look at this chart. This is a chart of all debt in the United States. This is something called TCMDO, or Total Credit Market Debt Obligations. This is the sum of all debt in the U.S., personal, including credit cards and mortgages and home equity loans, to business debts and small business loans, and it also includes all government debt. city, state, local, and of course the federal government's $30 trillion of their debt. Now, when Paul Volcker went crazy with the interest rates to stop the inflation of the 1970s, the total credit market debt obligations in the United States came up to $4.2 trillion combined. That's all mortgages, all personal, private, public, federal debt in the whole country. $4.2 trillion. So when he raised interest rates above 15%, it was 15% interest on $4.2 trillion of debt. Individual interest rates varied. We're just going by that base 10-year Treasury rate. Well, now the total credit market debt obligations in the United States comes out to $91.2 trillion.
That is one big pile of shit.
Now, if we raise interest rates like Paul Volcker did to 15% to get this inflation under control, you think that might be a little bit too expensive for some people to handle? 15% interest on $91.2 trillion worth of debt? And that's why we're already seeing cracks in the financial system, even though interest rates are only at 3%, because we're at 3% of a much bigger number this time around. So this is why I say this time is different. Every time we have had some kind of financial crisis in the past, our answer has been to lower interest rates and or print money. And while that did stop the bleeding, that has resulted in this $91.2 trillion debt bubble that's currently in the process of imploding. And it's also resulted in this runaway inflation, which is worse than it was in the 1970s. Well, if we decide to save the banks from imploding, we make the inflation problem worse. And if we decide to stop making the inflation problem worse, we cause the banks to implode. Do you see how we're in this problem right now? Central banks and generations of irresponsible borrowing has painted us into a corner, and there is literally no way out of this mess without causing widespread pain all over the world. There has never been a crisis like we're facing right now. There is nobody on this planet alive who has ever lived through anything like this. And therefore, anybody who tells you they know what's going to happen is full of it. Nobody knows what's going to happen because this has never happened before. Now, there are some people who make perfectly legitimate arguments that they may choose to bail out the banks again, that will save people from losing their pensions like just happened in the UK, and that'll keep people from losing their savings, and that is the more socially responsible thing to do. However, that means that savings will become worthless because that money won't be able to buy them anything because the inflation problem will have gotten worse. And then on the other hand, there's perfectly legitimate arguments that say, no, they're going to keep raising interest rates to fight inflation because they want to preserve the US dollar status as the world reserve currency, and that is incredibly valuable. And therefore, they're going to raise rates, and they'll keep raising rates until they get this inflation under control. And maybe they'll do that, but if they do that, then the banks fail. Then people lose their pensions, and then that debt bubble implodes. Because remember, $91.2 trillion, we can't afford higher interest rates on all of that debt. And there is no way to solve either problem without making the other one worse. I don't have a crystal ball. I don't know which one our leaders are going to pick, but they will have to pick. They will have to choose, and the world has never seen anything like this. Not in 2020 with the pandemic, not in 2008 with the global financial crisis, not in the 1970s with the inflation, not in 1929 with the Great Depression, not even in 1923 with Weimar Germany and the hyperinflation. There has never been a crisis with such a damned if you do, damned if you don't scenario. As always, I will do everything I can to stay on top of these stories and bring you up-to-date news as it comes in. But for now, with this story in Credit Suisse and is this bank about to fail, only Credit Suisse knows that, and they will assure you that everything is fine right up until it isn't. Remember, these things can happen very fast, out of nowhere. Just take, for example, what happened with the UK pension system last week. And if you want to know a little bit more about that, you can check out this video I did about how liability-driven investment almost caused the UK pension system to fail last week. Till next time, live small and dream big.